is earning something from the contract, whether the contract has some intrinsic value for the buyer, that the option contract will be exercised. Under this, we have done the call option in detail. Call option was the right to buy the underlying asset, but not the obligation to buy. So when will the buyer exercise the call option? When the market price of the underlying asset has increased, okay? Or you are expecting, you will buy the call option when you are expecting an increase in the price of the underlying asset. And you exercise this option when you see that the market has actually turned out to be as per your prediction. So then the call option is exercised. If that is not the case, if the underlying asset is available at a price which is lower than the strike price of the option, then the buyer will let the option lapse. For this added advantage, the buyer has to pay some premium to the seller, and in case of all option contracts, it is the buyer who has limited losses, potential for limited losses and unlimited profits, while the seller faces a scenario of limited profits while there is a potential for unlimited losses and limited profits. That is what the seller gets from an option contract. Then under this, we did the example. I explained you the concept of intrinsic value. This is the last topic which we did, a long call. The buyer of a contract is in the long position. The seller of the contract is in the short position. So long call is a simple call option contract from the perspective of the buyer. So instead of holding a stock wherein you are facing a risk of unlimited losses and a potential for unlimited profits, you try to play it safe. Instead of making the entire payment today, just by paying the premium, you get the right to buy the underlying asset at the price decided today. Okay, and then given the nature of option, whether it is an American option or a European option or an European option, you can exercise the contract as per your convenience, as per your profitability on the expiration date. So graphically, this was what we did for we did under the long call option. If you see, green line is telling you the payoff from the call option for the buyer. So loss is limited. Loss will take place only when you are not exercising the call option, and loss is limited to amount of premium paid by the buyer. So it is a straight line, and then depending on what the price is in the market, you have a potential for unlimited profits. While if you are going for a simple stock purchase, because our underlying asset here is a stock, then you are facing equal probability of profits and losses. The second type of call option contract, or from the perspective of the seller, the call is a short call. What is a short call? For the seller, it is the obligation to sell the underlying stocks if and when the buyer exercises the call option. Okay, I repeat myself. It is the obligation of the writer of the call option to sell the underlying asset whenever the buyer wants to exercise the call option. Now, American options can be exercised on the expiration date or before the expiration date. while an European option is exercised only on the expiry date. So, depending on what type of option you have purchased, this makes the seller bound, the writer bound to fulfill the requirement as and when the buyer exercises the option. Okay. Now there are two types of short call from the perspective of the seller. One thing is that the seller also waits for the buyer to exercise the option, and whenever the buyer wants to exercise the option, the seller will purchase the stock from the spot market. दिस इज अ वेरी रिस्की सिचुएशन क्योंकि बायर कब एक्सरसाइज करेगा ऑप्शन जब मार्केट प्राइस ज्यादा है आपके एक्सरसाइज प्राइस से तो उस केस में अगर 50 रुपीज में आपने प्रॉमिस करा है कि आप शेयर सेल करोगे तो बायर आपके पास तभी आएगा जब मार्केट प्राइस 50 से ज्यादा होगा तो इफ यू आर नॉट कवरिंग दिस ऑप्शन it is an uncovered short call also known as a naked short call then the seller will have to buy the security at a high price from the market and deliver it to the buyer of the call option. The trader might not want to take so much risk, so they can hold some securities which will be delivered once the buyer is exercising the call option. So holding securities along with selling a call option becomes a covered call. You are covering your risk. So let's take an example. A short call will always give you probability of limited profits because profits will take place, as I've said, for the writer only when the buyer lets the respective option lapse. Okay, so for a share, your Nifty current price is 9600. You sell ATM call. ATM call is at the money call for 9600. Premium received is 110. The break-even point is point of no profit, no loss is 9710, and the lot size for this call option is 75 shares. Okay. Now, when you sell this call option as the writer, you receive a premium of 8250. 8250 is 110 into 75. Now, this is the earning of the writer as long as the option contract is not exercised. Now, the share was the strike price for the option was 9600. If the market price falls below 9600, the buyer will not exercise the option and the entire premium becomes the profit for the writer. Okay, now the problem arises when the market price, I think there is one slide missing there. The problem arises when the market price moves beyond the exercise price. Okay, so now if the market price moves beyond, say the break even is 9710, 9600 के beyond जब भी market price move करेगा, there is a probability of loss for the writer of the option. If you see, this is the payoff from the for the short call, obviously from the seller's or the writer's point of view. As long as the price is less than the strike price, there is a chance of limited profit. But when the price increases beyond 9600, then it is at the discretion of the buyer whether he wants to exercise the option or not. So there is a chance of unlimited profit. So what happens is that the probability of making profit is for a writer is dependent on the price movements in the market. Okay, so this is a simple short call. I hope this is clear. Then we come to the second main type of option, which is the put option. Now, very clearly understand the put option gives the buyer the right to sell the asset. Okay, buyer here will be selling the asset. So the counterparty, which is the writer, will have the obligation of buying the asset. Okay, so buyer of a put option has the right but not the obligation to sell the underlying asset, while the writer of the put option has the obligation to purchase the underlying asset whenever the buyer will exercise the put option. Now, when will the buyer exercise the put option? Buyer will exercise the put option when the market price falls below the strike price. So you get a chance, you get the right to sell the asset at 100 rupees. Market price falls to 90. When others in the market will be selling their share at 90 rupees, you can sell your share at 100 rupees under the put option. Okay, so put option will have a positive intrinsic value when the market price is below the strike price, and a negative intrinsic value, or negative is not the term, we say zero intrinsic value. So that will be when the strike price is lower than the market price. क्योंकि अगर market price 100 से ऊपर चला जाता है, then the buyer of the put option would prefer selling the shares directly in the market and will let the put option lapse. Okay, so the payoff for a put option is the mirror image of the call option payoff. This is one simple example. So, under a put option, the buyer gets the right to sell 100 shares at a price of rupees 300. 300 is your strike price after 3 months. So, the current price of the share is 250 and the premium paid is 25 per share. Lot size is 100. So, the buyer is paying a premium of 2500. Now, after a month, the market price of the share falls to 200. The buyer has the choice of exercising the option because here he can sell the share at 300 per share. So, which is a profit of 100 rupees per share, and the lot size is 100. तो 10,000 का सीधा सीधा प्रॉफिट हो जाता है पुट ऑप्शन बायर को, होल्डर को, माइनस the 2,500 paid as premium for the put option. That gives a net profit of 7,500 to the put option holder. Okay. On the other hand, if market price is 300 or something higher than this, then the buyer will let the put option lapse, and the loss of the buyer will be the amount of premium that has been paid, that is rupees 2,500. Okay, so this is one more example of how you make the payoff of a long put, or from the perspective of a put option buyer. So the example is of a treasury bond for which the exercise price is 76 and the option is an American option. Say this was purchased on August 19 and can be exercised at any time between now, August 19 and September 19. And the cost of put, that is the premium, is rupees 2. What happened? Is there any network issue from my end? Okay, okay, Yuvraj. So the treasury bond was the exercise price of this put option is 76. So you see at tentative price of 76 on September 19, the gross payoff on the option is zero. Gross payoff आपकी intrinsic value होती है और net payoff आपको actual profit या loss बताता है. तो 76 से जब भी हायर होगा प्राइस मार्केट में तो जो इंट्रिंसिक वैल्यू होगी ऑप्शन की वो जीरो होगी. So as I said, the option contract will never have intrinsic value is never negative. It is either positive or a zero. So when the option is allowed to lapse from the end of the buyer, then the intrinsic value of the option will be zero. But then the net loss to the buyer is of the amount of premium, which is 2 rupees. On the other hand, if the price in the market is lower than 76, then accordingly some profit is earned by the buyer of the option contract, of the put option contract. So this is how the payoff of the buyer looks like. If you have a look, then the buyer is limiting the loss and can enjoy unlimited profit depending on what is the market price. Again, if you look, this is just the opposite image of the call option payoff. That is why we say it is the mirror image, left to right, right to left. तो ग्रॉस जो पे ऑफ है वो आपकी इंट्रिंसिक वैल्यू के लिए है और जो नेट पे ऑफ है वो आपका अल्टीमेट प्रॉफिट और लॉस ऑन द कॉन्ट्रैक्ट. For the writer, it is just the opposite. Maximum profit up to rupees 2 per treasury bond here per unit of the asset, while the chance of unlimited losses. So there will always be a difference of 2 rupees between net and gross payoff. That 2 rupees symbolizes the premium received or paid. So that remains consistent. Okay. So like the simple call strategy, we come to a simple put strategy. First is the long put. Long put is always for the buyer of the put option who has right to sell the underlying asset. For the buyer, the loss is limited and the profit is unlimited. Okay, another example is given here, but more or less we have discussed examples wherein the put option long put will be exercised only when the market price falls below the strike price of the option. Then short put is from the perspective of the seller who will be required to buy the underlying asset as and when the buyer will, sorry, the short put is from the perspective of the seller who will be required to buy the underlying asset whenever the buyer of the put option is exercising. So again, this can, as I told you, it can be a covered put or an uncovered put, and the possibility of loss is unlimited while of profit is limited. Okay, so this table is just generalizing, summarizing what we have done till now under the simple call and put option. Why am I emphasizing again and again on the meaning? Because post this, we will be doing combination strategies. So therein we are not talking about simple call and put, but how people, how investors, they hedge the risk by combining these option contracts and simultaneously holding the asset with them. So how people, how investors, they not only hedge the risk but also increase the probability of profits by combining the call and put option. Okay, so please have a look, take a minute, just read the meaning of both the option contracts. Because if there's some doubt, then I'll address it here. Any doubt, any question? Last, is this clear to everyone? Okay, so I'll just take up a small topic. टर्मिनोलॉजी में हमने इंट्रिंसिक वैल्यू बहुत बारी डिस्कस करी है. उसको मनीनेस भी बोलते हैं ऑप्शन की. What is the profit or loss potential from the exercise of the option? So option can be in the money, at the money, and out of the money. ITM, ATM, OTM. Call option will be in the money when spot price, market price is greater than strike price. At the money when spot is equal to strike price, and out of money when spot price is lower than the strike price. On the other hand, put option will have a completely vice versa case, where it will be in the money when the spot price is lower than the exercise price. At the money will be the same, and out of money will be when the spot price is greater than the strike price. Out of money options are not exercised. Okay, this is, I think we have done this already. Meaning of intrinsic value. Just remember, intrinsic value does not consider the amount of premium. So that is considered only for the net profit or net loss from the option contract. So here is one example wherein you are given the call option and the put option strike price and the premium, and what is the scenario under each of the tentative prices. So you can clearly see that for the call option, the strike price is, okay, the stock is for 100 intrinsic value of a 85 call option. So strike price is 85. And wait, I think I'm not reading the question correctly. Stock price is 100, then the intrinsic value of a 85 call option is 15. So which means the strike price is also 100. So if the market price is the strike price of the option is 85, the market price is 100. So the call option is being sold at 85. So currently at point 0, the intrinsic value is 15. Now, whenever the market price is increasing, there is a subsequent fall in the intrinsic value of the option. So which is shown to you horizontally. You move through the call option row, then you are seeing that 100 is 0 hai intrinsic value, and beyond 100 also the intrinsic value will continue to be 0. So it is worthless to exercise the option. For the put option with the same values, 100 and above, the intrinsic value for the put option holder is 0 because the market price is this is from the perspective of the holder. Wait. Put option 110 की है on the same stock and market price is 100. So accordingly the value has been calculated. Okay, for the put option holder. I think for the put option holder this is not correct. Is there a mistake? Please check.